Hello and welcome to the home of high probability trading. My name is Tim and I'm one of the traders here at the live trade room. What we look to do is to trade the financial markets during this US Open, and we're trading these markets fully live and interactive, and you'll see us how we prepare for these opportunities, how we engage with the markets, how we have a strong focus on risk management, and we'll go through that whole process. So hopefully you'll enjoy it. You'll be able to benefit from hopefully some good trading ideas, and you'll see most importantly how we can act and behave in a very controlled, considered, educated fashion, and with one purpose, and that's to make consistent returns. So just before we begin, if you are genuinely interested in learning how to trade the financial markets, we can certainly help you as an organization. We've got a wealth of products and services available through the live trade room, and we've got these available at very, very low prices, from as little as $15 per month. So very affordable, and it's really high quality stuff, and you get access to a whole variety of different live trade rooms, different products. We've got over 50 hours of education. We've got things like our trade size calculator, so really, and an awful lot of support as well. So really it's a comprehensive education for you, and you get a little bit of a taste in terms of what we do during the session. Okay, so on that note, let's start with a risk warning, and we'll see if we can make some money this afternoon. So actually a big day yesterday and a big day today, which we'll explain now in just a moment. Please, of course, take note of the risks involved in trading these financial markets. Okay, so let's start with a very quick review of some of the fundamental and news events which are really dominating these markets now. And we were speculating over the last over the last couple of weeks that this market needs some additional drivers, fundamental drivers, just pushing price action, and we now have those in place. So if I take you just to last night's news event, we're in I suppose we're talking about kind of post-COVID now, and the potential upside that has on economies. There's this massive pent-up of demand, and as a result, people have a little bit more money in their pockets. And the idea is, especially with the coronavirus relief fund, where Americans were receiving $1,400 checks to spend in the real economy, that's being played out across a lot of the indicators, certainly the economic data indicators. So with all of this in mind, we've had the FOMC last night. So just take back a step, or take you back a step, should I say. Last week we had BOC just look to taper their bond buying, which they decided to go ahead and do at a rate of 25% of their current bond buying levels. The same question has been asked to the Fed on many, many occasions, and again last night, but they've kept rates very accommodative, less than 0.25%, and the quantitative easing is remaining in place as well. And the reason why that's important is because the Fed have been very, very supportive of stock markets, and we've seen stock market prices push higher. And now the Fed have sort of reassured the markets that we've got this really nice environment for growth in the US, and there's no reason to suggest that prices would be moving lower anytime soon. And what we've seen is that renewed confidence now in these markets, having moved sideways for a couple of weeks, are now actually pushing higher. So we've got a little bit of clarity behind the fundamentals and the sentiment behind this market. It's really strong, positive sentiment. We are at sort of extreme all-time highs, and there's every reason to suggest that that's very likely to continue. Sorry, just bear with me one second. Yeah, that's fine. Okay, so with all of this in mind, we've got really strong, favorable markets towards the indices markets, and on almost a global basis. Certainly, your G7 and potentially favorable for markets like crude oil, and we're likely to see a little bit more weakness creep in to the dollar. So it just depends where the moves are occurring, and it's really quite easy to identify where those moves are occurring. I'll show them to you in just a moment. So that's just going back a step from last night. We also had Biden speaking in the early hours of the morning with his speech on the his plans for supporting the US economy and how they're going to increase taxes in order to sort of contribute towards paying for a lot of the programs which they are looking to roll out. So just an eventful few hours really for the US stock markets and the US dollar. What we do have at 1:30 in about 60-70 minutes time is advanced GDP figures. So that's the final news event of the week really. And it's very likely to be a very, very positive number. So that's likely to support stock prices even further. So we can really look at these markets and prepare for certain moves. So with all of this in mind then, let's see how we can, let's look at our trade plan from last night. So every night at 9 o'clock we have our trade plan webinar, and it allows us to just identify some of your higher probability trading opportunities. And these are the markets that we're really looking at, and there's two markets that are really standing out. So we're not really surprised to see more dollar weakness creep in against the euro dollar. We've rolled back off the highs, and we've seemed to have done that across all of the dollar pairs. The pound extended to the upside and has now just kind of reversed and rolled over. The dollar CAD, it's just trading down at these significant lows. So we'd expect further continuation from there. And the Aussie dollar, again, we've seen moves in all of these four markets in the direction in which we're looking to trade them, but we just got to be mindful of trading what we're seeing in terms of the pullback right now, and we'll assess each of these independently just before the 1 o'clock US cash open. So the two major markets to focus on would be the US indices markets and crude oil. So let's take a quick look, and this is some of the, so if I just get up my pen up on screen, just bear with me a second. We've been in this little sideways pattern now for 2 weeks, 2.5 weeks, and only now we're seeing these markets accelerate to the upside. So we've really got that 4,200 really level in mind, and we're now breaking above that level. So the question we now ask ourselves when we trade these markets is, are we seeing the correlation play out across the other markets? And the answer is categorically yes, we are. So we're very close to making new all-time highs now with the Nasdaq. We had really good earnings from Apple, so they're performing really, really well over the course of the previous quarter. So we're seeing a bit of an uptick in your tech stocks. Dow Jones, we've got bullish market conditions. I think that's fair to say. Same with the FTSE. We're seeing these markets tick to the upside. Actually, the DAX has been an interesting one. We've seen, obviously, as you can see, prices rolling lower, but the Nikkei is continuing to strengthen. So just a quick look on Bitcoin. It has a real interesting question to answer really at these levels, that $55,000 level. Will we get a next leg to the downside, or will we start seeing prices reverse and push higher? So a few question marks over Bitcoin at the moment. So the other market really to take note of would be your crude oil market, and we're just breaking out of this level. So this is our second structural failure trade to the upside. There's the first one. We broke to the upside, we drifted sideways, we pulled back a bit, and now we are just seeing the second breakout to the upside. Now it's just important to note we are closing out the month, so and when we close out the month at these highs, you can expect a little bit of a retracement off the highs at some point between now and at the end of the calendar month. Which would be tomorrow's trading session. So let's have a look at okay, so we do have a bank holiday on Monday, being May Day, and sorry, today is Thursday. So tomorrow's the last day of the trading month. So yes, we are seeing these markets accelerate. You just got to be a little bit careful or a little bit mindful about some of these at some of these highs, because you just get a little bit of corrective price action. There's a little bit of reconciliation go on towards the end of the calendar month, but the most exciting trade is probably the continuation trade next month. Would we anticipate further momentum to the upside for these indices markets and markets like your crude oil? The answer's absolutely. So let me see.
So we're moving into just under an hour now until we get the US GDP read. Just make everyone aware that we do have a piece written by our European editor Eric Kolb, just posted it on Twitter and the board for those that want to take a read. We are looking for an increase of 6.1% on the prior 4.3%.
So
This is widely expected that GDP will be spurred on by stimulus checks, vaccinations and open stores, spurring consumers on. Also, we have dwindling inventories, diminishing optimism, the other side of the coin.
So we'll have that advanced GDP figure now in just a moment. So we can certainly look for some continuation moves across the US indices markets and the let me see. So we've got crude oil here. And we've got the S&P pushing to the upside, crude oil, and then we've got the dollar, threatening to weaken. So that's really the focus. Just depends which market gives us the better opportunity out of these. So we'll just prepare those in just a moment. Okay, so okay, so we'll have a look at each of these now in just a second. When you get markets that are sort of making new highs and you're seeing a lot of volume and momentum to the upside, then it's often a case of looking or waiting for the pullback to get into that next leg to the upside. So we'll have a look and we'll weigh that up now in just a second. David, good afternoon. Hope you're well. Can you help me with exit strategies, money management, taking half off, and letting half run? When to move to break even? It's always a judgment call, breaking even. Now, scaling in and out of trades is very much a personal decision for you as a trader. We generally don't scale in and scale out that often, but what we often do is take multiple trades in the same market. So if we're buying the stock markets and we get into those trades and price kicks on, your question in terms of when to move to break even is a very, very important one, because firstly, it's as soon as we possibly can. So, and we're talking about making technical decisions here about these markets. So quite often when we get markets, I suppose a good example is the New Zealand dollar, which we're into the upside. And if you look at it on the daily time frame, we've had this little accelerated move. So this is a good example. So we got in above that high here. I think we had our stop loss at this level here at the point of entry. Prices kicked to the upside, and then you can see we kind of topped out, or let's call it there, and the market just pulled back. We actually gapped lower, and then we started to reverse that move to the upside. And to answer your question is when do we break even on that trade? It's always a judgment call, because what you want to try and do is give the trade enough room to grow, but you don't want to leave any capital on the table. So once prices kick on, we generally look to break even. So once we're up at these highs up here, we're generally breaking even on the trade, because what we don't want to do is this market to reject, come all the way back pretty quickly and stop us out for a loss. So once we get this, once or 1.5 times your risk, once the markets kick on to that extent, then you can break even. That's the first thing, and break even as quickly as you can, because what you want to try and do is, as objective number one, is to break even on as many trades as you possibly can, David. So if we get into 2, 3, 4 trades and you can break even across all of them, you're in a fantastic position to actually just purely focus on profit taking. So get to that break even, but don't be erratic with it. So if you've got a 50 pips stop loss, for example, and the price moves 40 pips, try not to move too quickly. So if it's 60, 70 pips, then that might be a better environment in which to break even. Does that make sense? So it is relevant to your exposure, your pip exposure, more importantly, than your monetary exposure. So your monetary exposure should always be a predetermined amount, a predetermined percentage of your capital. So if you're trading 1% of your capital, work out what that is. And if you've got a 50 pip stop loss, then you would just need to work out how much, what your trade size would need to be in order to make sure that you're risking roughly 1% of your capital. And don't do what many traders do, and we see lots of videos online about all of this, is that one size fits all to each market that you're trading. So, a one lot trade in the euro dollar, a one lot trade in the pound dollar, a one lot trade in the S&P, it doesn't really work like that, because each trade has its own unique characteristics. It has its own unique technical backdrop and understanding to each trade. So there's no such thing as a one size fits all, and we see that all the time. We see traders, they'll just continue to just trade, one or two lots per trade, and what that means is, what you often end up doing is generally oversizing.
Here, De Blasio announcing the New York City.
And the problem with oversizing is, if you do it over 100 trades, you're actually exposing a significant portion of your capital, and you're not intending to do so. So when it comes to risk management, do everything with intent. So understand how much capital you have, how much capital you're committing to each trade. Be comfortable with that amount of capital. If you're too nervous, you're probably trading at a trade size that's too uncomfortable for you. So all you can do is just reduce your trade size a little bit, and build up your confidence levels at whatever percentage you happen to be trading in. We have traders that trade at sort of 3 to 5% per market. So it is an individual thing, and it does really depend how much experience you have. Exiting strategies, just to be as straightforward as possible, we build up reasons to get into a trade. So we'll say structural failures to the upside, momentum's pushing higher, strong fundamentals, technicals, blah blah blah. So, and then what you're left with is a fairly straightforward decision. This is your entry analysis. So that's when you enter, you do your analysis, and you think, yeah, I like all these things, this is looking positive. There's no reason to kind of doubt yourself in a situation like this, and I'm going to buy that market. But the same is true when it comes to your exit. So what you're saying is, right, well, we can see exhaustion up at those highs. We can see a lot of rejections to the upside. We can see structural failures to the downside on lower time frames. And the daily candlestick is turning negative, whatever the case may be. Under circumstances like that, get out of the trade, book in your profit, make sure you don't risk any more than is necessary on the trade. So it's really going through the reasons for getting into a trade are often more, but we try to teach traders how to let your winners run and try not to be meddling too hard with your opportunities. You just never know which one's gonna fly. How do you use leverage correctly? Another great question, and the answer is very simple. You calculate your trade size. So leverage is irrelevant to us. It doesn't have any significant impact in our trading whatsoever, because we don't use leverage in a reckless manner. So we're not trying to leverage every trade we get into. So leverage is a double-edged sword. It's essential for access for most of us. Otherwise, the end goal for traders is to trade without leverage. If you can do that, that's the ultimate. But you do need, real significant amounts of capital to be able to trade these markets without leverage. So that's the best position to take if you possibly can. But leverage doesn't play any meaningful role with us in our trading. And that's just for one reason. We teach traders how to trade a percentage of their capital. So and it'll take into account, like something like our risk management software will take into account how much capital they have available, what the pip size is, the range between your entry and your exit. It takes all that information into account. It tells you what the pip value is for each trade that you get into, and you put things like what the notional trade size of each trade that you get into. You have to put in what one lot size is for each market that you're trading, and what it does is it gives you a trade size suitable for the amount of capital you're willing to expose in the trade. And when you're starting out, we generally expect or advise, or certainly from our experience, we've traded 1% of our capital, and then once you get more experience, you can increase that to 2%. And when we get sort of no-brainer trades, we can take as much as 3% of our capital on that trade. And that's often when you get these type of no-brainer type trading opportunities, which don't come around, especially over the last year or so. They don't come around that often, but when they do, you can increase your exposure, increase your trade size. So does that make sense, David? So how you use leverage correctly is by determining exactly how much capital you're committing to that trade, and it's one of the things that most retail traders fail to do. So they have no coherent understanding about how much capital they're committing to that trade. So what they're doing is they're often oversizing. They're often trading a percentage above what perhaps they intend to do, and that's okay on the one-off trade. But if you can imagine, if you plan on trading 1% of your capital and you put in a one-lot trade, for example, and that works out to be 1.5% of your capital, you've got 0.5% over, and let's say you spread it out over 100 trades. That's 50% of your capital that you've exposed to the markets without even knowing it. So try to avoid doing that unless you want to take a 1.5% risk trade. Then that's different. You're doing everything with intent. You're in control. It's like a business, deciding to put in a new software program. You know exactly how much that costs, and you make a decision as to whether the company or the business can afford to integrate this, to make improvements and things like that. So it's a conscious decision. It's a business decision. It's kind of a similar mindset with regards to trade size. So for us, a small bit of leverage is fine. You see, the problem is 50-to-1 leverage is not allowed in the EU and the UK. So you have to go offshore. You have to look at brokerages which are regulated outside of the ESMA, the EU, and the FCA. So if you are being offered a trading account with 50-to-1, just know that it's regulated outside the EU and outside the UK. There's nothing hugely wrong with that. We've got 3 brokerages. They offer regulated ESMA trading accounts or EU trading accounts, but they also offer alternative regulated accounts outside of the European Union, which allow increased leverage. So just be mindful of that when you're selecting your brokerage and the leverage that you get access to. So we did know it's quite confusing for you guys out there at the moment, because some of you, and we know from a few of our traders that they're saying they've got EU regulated accounts, but they're accessing 50-to-1 leverage and 100-to-1 leverage, and that's just not the case. That's not allowed no longer in the EU. So sort of bear that in mind. it can be a bit of a minefield. But then just going back to sort of, you know, when do we exit? Well, we're still in this trade because we've had no reason to get out of it. So, you know, we entered the market here, prices pushed up, came back to this level, and then we kicked on again. So when prices, you know, pushed up at these levels, so first of all, we bought the market to break it even. Then we put our profit. We moved our stop loss up to here to generate profit. And then markets kicked on to the upside, and then this market pulls back, and then we kick on to the upside again. So we bring our stop loss up, not really getting too close. We book in more profit on the trade, and then the market sort of pulls back to these lows down here, and now we are making new highs. So again, we can push our stop loss up to this, and what we're doing is we're allowing the market to determine when we exit, because we don't know whether it's 71.90, whether it's 72.40, whether it's 72.90, whether it's 7,500. We have no idea where this market is going, so we don't want to get in its way. If it continues to move higher, we'll continue to make new highs, and we'll continue to book profit as price pushes higher. And that's where it's at. So let's say this market reverses, and tomorrow or on Monday it just tanks down to the bottom side. What we're doing is we're booking in profit, you know, at this level. That's where we exit this market. Okay, we're leaving a little bit on the table, and we could go right up. In fact, we very well may do tonight is bring our stop loss up to here. But when this market does roll lower, we want to be able to book in profit at whatever level the market tells us, you know, prices are now beginning to roll over to the downside. So apologies if that's a bit messy on in terms of the content, but you can just see that we keep making a series of higher highs and higher lows, and this is a definition of an uptrend. So if you're in an uptrend, stay in it. There's no reason to get out of it. So it's just learning these skills to almost relax a little bit more, and not be too anxious to take profit. We work hard to identify these moves, so we want to get paid on them when we get those, you know, big moves, and we just don't know at what price this market is going to top out. But when it does, we look to book in profit at that point, if that makes sense, and I hope it does. Okay, so 10 minutes before the top of the hour then. But yeah, some good questions there, and let me know if you've got sort of follow-up questions, because I mean, we've got education, you know, we've got hours and hours of education on these very points, David, so there's a lot more to it, but that's broadly just a bit of an outline. So let's revert back to our trade plan then, and we'll have a look at the euro dollar first. So we've had a nice move to the upside. We've had that continuation trade. We were looking for this market to continue above the 2134 level. Just look at the bigger time frame. Look at, you know, these highs in here. We've now broken to the upside. So that's the euro dollar. It's just continuing to grind to the upside. So again, that principle remains. If we look at it on the smaller time frame, so it's interesting to see that we saw overnight, we saw a structural failure trade to the downside, where the dollar started to strengthen a little bit, but just bounced off the monthly high. And this is why we use these monthly highs, monthly lows, daily highs, daily lows, because it just provides us with some of the the resistance that we need. So we're now at this little stage as the market reopens. So it's going to be interesting to see, you know, do we get equity markets pushing higher? Do we get the dollar continuing to weaken? It looks like that's the case. So what we're looking for in this is a structural failure trade to the upside. If we get a little bit of softening, and then we get that little move to the upside. So we're reversing this structural failure to the downside. We now want to reverse that and see a structural failure back to the upside. If that makes sense. Prices, sorry, pushing higher like that. And trading for us is all about putting expectations on these markets in terms of what we want to see happen. So there was an opportunity there probably about an hour ago to sort of get in on this increasing price at 21, 24. We did have a little bit of an issue in terms of the stop loss placement. This was always likely to be a little bit too tight. So if you get in at 21, 24, having a 14 pip stop loss in a market like this, it's a bit on the tight side. So now if prices begin to soften a little bit, if we come back to 121, 24 and then we accelerate, getting in above the 121.34 it gives us a little bit more room to work with. So then we can have, you know, like a 25, 30 pip stop loss, perhaps something along those lines. So let's amend this one. So we're looking for that structural failure trade to the upside now for the euro dollar. The pound dollar, let's see if we're in the same position. You see, this is a different position, so you can see that we're now in a little downtrend. So you can expect lower highs now in this and lower lows. So it's really until you get that little turnaround trade, and a pullback to 39.17 would be an interesting trade for us. So as a result, we look for a high probability buy trade. So it's actually a pullback buy trade around 39. In fact, let's just change that one more time. Okay, so it's really just a pullback trade, and you can see it probably a little bit better on the 1 hour. So if this market comes back to roughly the 39.20, that might give us a little bit more confidence for a neater trade to the upside. Could probably work with a kind of a 30-35 pip stop loss, maybe down to this one actually, to be a little bit safer in this trade, because there's plenty upside left in this move. Okay, so the CAD is continuing its move. You can see crude oil continuing its move to the upside. So it's a case of potentially trading either one or the other. We've kind of maintained this little level up on screen. And now we are just breaking that level. It's worth noting how much further to the downside do we have in this trade. Let's look at it on the weekly. We can certainly expect prices the 122 sort of 50 level. So it's bounced off the 22. So 23.13. So it's about a 30 pip stop loss, something like that. So we're getting that close below that level, and now it looks like we're getting that follow through trade. So we might be getting into decent breakout trade now in just a second. High probability breakout sell trade below. This time it's the 22. So yesterday it was the 123.82. We booked in a decent profit on that trade yesterday, and now we're looking at the 22.81. 22.81. If we just get continuation to the downside, Okay, so if we get a little sort of continuation trade just below that 122.80-81 level, then we're back on to the downside. You can see the little break of this little low in here. So we've got a nice little structure. The last time we had a similar structure was back up here. So we're able to get in on the breakout and stop loss above, and we had a really nice move. So it looks like we can get into that trade now in just a second. So we got the close below the level. Now we just need to follow through. Of course, the one major problem is the GDP figure, which is due out shortly. Might provide a little bit of volatility. So we don't want to probably get into the dollar CAD and just get slammed out of it in 15 minutes later if there was a little bit of sort of market volatility. So it's probably worth waiting. Even if we had a positive figure and we had some negative price action, then it just means we can maybe get in at a slightly higher price. So let's just be cautious. We'll just wait for this GDP figure, which is due out in 20 minutes, and we just want to avoid getting slammed out of trades just prior to a big news event. Although our expectations would be quite positive. So we've got this advanced GDP figure, 6.8%. This is the last major sort of dollar news event. So we booked in some profits last night just before the FOMC. Markets have continued to rally post FOMC, but we've also had Biden in the early hours of the morning, and we've got advanced GDP, and this is the last of the three major news events. So what would be exciting is whether we finish the GDP figure with a degree of positivity. Okay, so we've got that advanced GDP figure. So yeah, we are getting that continuation trade in the crude oil and also the dollar CAD. Okay, we'll get a little market update now in just a moment as we go into this news event, maybe in the next few minutes. Okay, so we're just seeing these markets just squeeze higher, as you can see, as we go into this GDP figure, just to see okay, so we'll Okay. So we'll get a little market update now just regarding this GDP number. We can see the equity markets pushing higher and crude oil as well pushing higher. So it's just, broadly speaking, just a very, very good positive market sentiment, really. We'll just see if this... hello, Renko. Yeah, sorry, we just turned off the sound there just for a minute or two. Yeah, I hope that's okay. And look, we're seeing this market accelerate to the upside. So really positive market conditions for your indices markets. Nasdaq is very close to making these new all-time highs again, and the Dow Jones is all looking quite positive. So really, it's a focus on US indices. And I'm sure we'll get a little update now in just a moment. Crude oil as well is also ticking to the upside, so we like this above the 64.40. Well, the initial trade really was the 62.30, and we've just accelerated to the upside, so a really nice move in that. That's crude oil. So the yen is continuing it to weaken across the board. The problem is the dollar and the yen are both weak at the moment, so we're seeing the dollar largely weaken off against most currencies, like the CAD. And this is just why we just stayed out of this just little CAD trade, which the opportunity was there, but going in so close to a news event, we don't want to expose capital unnecessarily.
So we're seeing here German 10-year bond yield rising to the highest level since March 2020.
Okay, so the US indices and the crude oil markets are all ticking to the upside.
So we're just moving into 3 minutes now until we get US data for Q1. GDP, we're looking for an increase to 6.1%. With the personal consumption, we're looking for an increase to 10.5%. GDP price index, we're looking for it to increase to 2.6%. With the core PCE, quarter on quarter, we're looking for an increase to 2.4%. The weekly initial jobless claims, we're looking for 549,000, range 520 to 610,000. With continuing jobless claims, we're looking for 3.614 million on a prior 3.525, on the range at 3.525 to 3.7 million. Looking at a note here from IG, they are expecting today's growth forecast to come in at 7.4% annualized, led by stimulus fuel consumer spending. They say with the vaccination program, meaning more than 142 million Americans have received at least one dose, and the economy opening up more and more each day, the growth rate could be in double figures for Q2.
Okay. So the GDP figure out now in just a couple of minutes. We'll just see how these markets react to this event.
Still waiting on the GDP print, but 553,000 for initial jobless claims, with the continuing coming in at 3.66 million. So the weekly jobless claims there, 553,000 last week, prior revised 566 from 547,000. Continuing coming in at 3.66 million, prior revised 3.651 from 3.674 million. Still waiting on the US GDP numbers. 6.4% for GDP. So
6.4.
Q1 grew
okay.
at 6.4%.
So that's the level advanced GDP figure, 6.4. We're expecting 6.8. So let's see what the initial reaction is now from these markets. It's still quite positive numbers, not quite as positive as perhaps it could have been. We're seeing the
10.7% for personal consumption. The GDP price index coming in at 4.1%, with core PCE quarter on quarter at 2.3%. So just to recap that, US GDP annualized quarter on quarter 6.4%, personal consumption 10.7%, with the GDP price index at 4.1%. Core PCE quarter on quarter 2.3%.
okay, there's that 6.4% figure. So Yeah, and we saw a nice uptick in the advanced GDP price index quarterly figure as well. So it's kind of a mixed bag, isn't it? The unemployment claims are slightly higher than anticipated. Not too much, sort of 8,000 jobs, so not a huge amount. So let's see what the initial reaction is. It's a bit of an attempt really for the index markets to continue pushing higher. Let's say mild dollar weakness, continuation in that direction. So the crude oil market is just now at the monthly high in around the $65 level.
Looking further into the report of GDP, the inflation-adjusted value of domestically produced goods and services climbed to an annualized 19.09 trillion, indicating that GDP will soon eclipse the pre-pandemic peak of nearly 19.3 trillion.
So there's the initial reaction now, sort of what 4 or 5 minutes in, is not much action as far as the S&P is concerned just yet, but threatening to sort of for the dollar to continue to weaken, which would be the trade that we'd be looking for. So you'd want to see the euro dollar above the one. In fact, we can probably take this high in here. The 21.36. You'd want to see this market break below the 122.80 level. Crude oil, if we can get a corrective move, we can perhaps get into that to the upside. And the S&P is not really doing anything just yet, so let's see if it just needs a little bit more time to basically kick on.
Seen here that France are said to end curfew measures from June the 2nd. So that's French media, they're reporting that France plans to end their curfew measures from June 2nd. And Macron there saying to regional press that France is to reopen in phases from May the 3rd.
Okay, so it's always interesting to just see how the markets initially react. Now we're likely to get some indices strength at some point pretty soon. It's certainly not happening with any degree of momentum just yet, but it is looking like we might get some dollar weakness, which could be a focus, and the crude oil market is just continuing its move. So it's largely off the back of reopening economies and just positive sentiment regarding these markets. So we've now sort of broken to the upside. The trade was kind of above yesterday's high, the 64.46 level. We've now pushed quite high, quite significantly to the upside. There was an attempt at a pullback, but it was really very shallow, so very little opportunity to get in on a bit of a pullback this morning, and now we're just continuing to the upside. So a constructive pullback on crude oil would be a high probability trade to the upside for crude oil. The S&P actually above that 42.17 would be an interesting level higher. The dollar CAD, you still want it to break below the 122.81 level. The euro dollar to break above the 121.36, and the initial move to the upside for the pound looks like it's kind of fizzled out. So there's no doubt about it. If we look at the figures, there is reason to just be a little bit more cautious, but this is a quarterly GDP figure, is a fantastic figure. It's so hard for them to kind of forecast some of these figures right now with the disruption due to COVID. So 6.8 was expected to be a very stellar performance. And we just came in a little bit lower than that, and the unemployment claims came in a little bit above expectations as well. So GDP is not quite as expected to the upside, and there's a few more people claiming unemployment benefits above what was expected. So it's not quite feeding through just yet. So listen, we do have to let you guys go there. We have other trading sessions now with our traders, so we'll let you guys go. If there's any questions, feel free to contact us and let us know. But we'll look for something constructive in crude oil, and perhaps the S&P above that 42.17 level, the euro dollar above the 21.36, and the CAD below the 22.81. So we could be close to getting into some opportunities there, so we'll see how we get on. So look, on that note, thanks very much for joining us as always. Do take care. For more information, go to our website, thelivetraderoom.com. And just to let you know, we don't have this session on Fridays at the moment. We will do hopefully pretty soon, but for now it's just Mondays, Thursdays. So and also next Monday's a bank holiday unless I'm mistaken, so we won't have this session on Monday either, but we will be back from Tuesday onwards at 12 noon. So we hope you can join us for that. So from everyone here at the Live Trade Room, thanks very much, take care, and we shall look forward to speaking soon. Bye for now.